Per usual, on this channel is for educational purposes only and is not intended as financial advice. Had a question about position sizing in the Discord chat. We've got a Discord now. The link for that is in the description of this video. A wide-ranging variety of topics that has been quite interesting because it's kind of been barbelled. It's mostly been BTC, ETH, and Sol, and then the absolute most degenerate stuff. Nothing really in the middle yet. Anyway, I had a question about position sizing, and I haven't really talked about this, maybe ever, because it's not something I'm great at, admittedly, and it's just so highly personal, depending on your trading style, where you're at in the world, which exchanges, which pairs, are you spot, are you leverage, are you options, do you worry about taxes, is this a tax-free vehicle that you're trading, right? So there's tons and tons of variables to consider. I'm going to try to provide some educational information and examples, 2 current examples I'll go through in the back half. And the first thing I do is figure out your personal system. What are your allocation buckets? I'll talk about that in a second. And I feel like for most people, eventually you lean on intuition a lot. You lean on your ability to properly understand risk, properly evaluate your edge in a specific environment, whether that's technical analysis, fundamental, understanding that flows are going to be XYZ because the entire ecosystem is deleveraging. Flows is going to be XYZ because we're getting these new products in the institutional space that have never been here before. Understanding flows based on having eyeballs, liquidity, right? All the kind of stuff we talk about on this channel every week is in a way helping inform my own intuition for trades, right? And then there's the other side of the equation where it's like, look, none of this matters, Josh. Variables? What variables? I wake up, I put on the black turtleneck every day and I go to work, right? That's unit sizing. That's where you say 1 unit is 50 grand or 1 unit is 1 BTC. And then from there you can say, okay, chart pattern, that's 1 BTC on the initial unit size, or a breakout trade, that's 3 BTC unit size, or a reversal pattern, that's X size, or a trend, I'm going to start with 1 unit and continue to work my way up. I don't think most people actually do that, but there certainly are people who do that where they have proper unit sizing. At least in crypto, I don't see too many of them talking about this. Proper unit sizing, very specific risk limits, every single trade, no matter what. My understanding of most of crypto traders is, here's my collateral, here's the 20x button, 100% 20x. You know, it's basically binary, rich or wrecked, fully wiped out pretty quickly, or oh my God, I'm a genius, right? Ultimately, what position sizing helps you do is stay at the table, allows you to make mistakes, allows you to capture the upside, gives you the opportunity to be comfortable with the confidence in your trades, right? And I think there's a great argument for just not having to worry about one more thing with the unit sizing side of things. Part of your whole system should just be, okay, this is TA, you know, like me. I see a chart pattern, I know what to do. I see a cloud breakout, I know what to do. It takes 10 seconds or less to immediately identify that stuff because I've been doing it for so long, which isn't a brag, but I'm just saying it's part of the system. I just boom, boom, boom. I know what to do. I know what the decision tree looks like on the TA side very quickly, right? And once you get comfortable with that, I think then you start to look for other ways to hone your edges, including dealing with sizing and risk and volatility and drawdown and that sort of stuff. So if we go through the allocation buckets, I talked about this, I don't know, 3 or 4 weeks ago in a few different places, trying to get people to sort of audit their own holdings and make sure that's where they want to be for the potential move. This is going to change for everybody. This is going to change from cycle to cycle. This is going to change from month to month for some people, whatever, right? These are just examples. If you're a Bitcoin maxi, you're fully Bitcoin hodl stack hardware wallet, right? There's nothing else to do. Most people watching this channel are probably traders. They're probably trading with leverage. They're probably on some sort of decentralized exchange or offshore exchange where there's custodial risk. They probably have a smaller stack, if I had to guess. Notional size, probably 50K or less for most people. And there's a great argument that those people probably shouldn't even be trading, okay? So you really have to be very careful taking any of these examples exactly literally and just understanding where you're at. So let's say we have a pile of crypto, right? This is kind of what my stuff looks like. None of this is exactly the same, but similar. Pile of crypto, okay. Half of it I just put in a hardware wallet. Half of it I trade. Again, this is part of risk management, custodial risk. This is living through the Great Depression, right? People who lived through the Great Depression live their life completely differently. They'll save bottles and cans differently. They'll hoard things differently. They'll understand food waste differently, right? Okay, so when you see exchanges blow up every cycle, you tend not to leave your entire stack on an offshore, unregulated bucket shop, okay? Or you don't leave your entire stack in DeFi in a bridge. I think you get my point here. Or you don't leave your entire hedge fund on FTX, okay? That's just something that most people with proper risk management understand basic custodial risk. And there's always going to be an argument to concentrate risk in a specific spot. Oh, their liquidity is better. Oh, they give a yield. Oh, they connect to my bank and they give me withdrawals in the same business day, right? There's always going to be a reason, but you need to fight that, okay? You need to understand the risks, not your keys, not your coins. Okay, so we've got our HODL stack, our trade stack, and then from there, maybe we want to split this up to, multiple exchanges, centralized, decentralized, right? I've been playing around more with the centralized exchanges. They're pretty cool. So again, just take 5 seconds out of your day, write these numbers down, make sure you're not ultra concentrated in one place. Another thing that this helps you do, some exchanges have sub-accounts, some don't. A sub-account is just a way to partition your collateral effectively, right? If you're trading on margin. I know a lot of people these days are trading a lot of their crypto stack in legacy via legacy instruments, and me included, right? I've accounts all over the place doing all sorts of stuff. But again, I think understanding your allocation buckets is the first step to getting comfortable with position sizing. Because again, even me on a decentralized exchange, I'm like, you know what? I should have been sized like 5x what I was on that last breakout on the decentralized exchange at a minimum. So once you get comfortable with trades and a system and dealing with multiple accounts and all that other fun stuff, right? Liquidity isn't going to be the same from exchange to exchange. I've traded on OKCoin, Cryptsy, Bittrex, Poloniex, Bitfinex, BitMEX, you name it. Okay, GDAX, Gemini. I could go on. And the liquidity is going to be different for different products. Some of those may or may not have leverage. Some of those you may get kicked off of from time to time if you're a US citizen, because we have crazy rules in this country. And that's going to push you towards taking more risk by putting more on the offshore exchanges, more into decentralized exchanges. And at the end of the day, that kind of hurts all of us. But anyway, so take some time and just quickly do this for yourself to understand, is that where you want to be, right? Do you want to be in a heavy alt allocation here, okay? Or would you rather have some cash? And then something else I think most people inherently do because they paycheck DCA, right? Have a good place for dollar cost averaging. River is great for that. It's free, okay? Boom, check that off the list. I don't have to think about it, right? Best exchange in crypto for US citizens. I love Kraken. Fees are lowest. Boom. Don't have to think about it, right? Coinbase has high fees, but they have USDC yield. Okay, maybe I swirl away some USDC there when I'm sitting in cash. Just go through the list, draw your decision tree, figure out what you're going to do. And then I think that really helps simplify this, because I think people start with, oh my God, I have this account. I don't really believe in TA, but this guy on Twitter said something. So let's go all in, right? So do a little bit of work on your end, a little bit of homework, right? Try to simplify the decision-making process. All right, let's say you've done all that. Great, perfect, or you already know that information. I thought it was interesting, of all places, Binance has a pretty good article on position sizing. I mean, some of this stuff is pretty basic. We're going to take 2% of our account per trade. So if you're on a DEX or an offshore leverage exchange, maybe that's the entirety of the account, but the account size itself is 2%. So that way, you're just simplifying the math depending on, again, your leverage, depending on how much you trust that exchange, etc. And good on them for listing this. You need to figure out where your trade is invalidated, which is effectively going to be your stop loss. And then from there, you can do some math to take it a little further. Again, I don't think anybody actually does this, but if you're new and you're constantly losing, I think putting up guardrails, putting the bumpers on the bowling alley can be super helpful, okay? I also think most people who are trading and new think, oh, I need to make some trades. I need to take some trades. I want to be a trader. I'm going to make a trade every day. No. This isn't sports gambling, okay? I make like 3 trades a quarter, okay? You take 2 good trades a year that are properly sized, you're fine. You're set. Obviously, that depends on what's going on in the markets, but just something to think about. Are you trying to hint hit singles every time? Are you trying to bunt to get on first base? Or are you trying to hit home runs? Are you trying to hit doubles and then steal a base, right? Like, what are you trying to do? That's going to affect your position sizing as well. I know tons of people who are effective, highly effective at trading super quick, low time frame trades and sizing those up massively and doing okay. That could be you. That isn't necessarily me, but it could be you. Bybit as well has another great article. They probably just looked at what Binance had, but they did have this kind of cheat sheet explaining risk, taking, a fixed dollar value. Let's say, I want $10,000 on this trade every time, this type of trade, or as your account grows, you're going to want a percentage. Some people like to think of it in terms of crypto. I want this to be 10 ETH. I want this to be 1 BTC, right? So a lot of variables there, but just something to think about if you're kind of oblivious to all this and don't know exactly what I'm talking about. And then there's the Kelly criterion, which is a whole nother ball of wax. I'm not even going to go into that at all, but something to read up on if you have no clue what I'm talking about. And a lot of the poker people inherently understand unit size, bankroll management, because they have those reps either in practice or in tournaments or whatever, right? They know how to deal with sizing. So if you're one of those people, you're probably going to have a better understanding of what goes into that. The fundamentals is one thing, right? The technicals is another. And then the trade management is something for most people completely foreign and different. So you need to also establish that muscle and learn how to do that. All right, some personal real world examples. This is one of my accounts on a crypto exchange, Kraken. Because of when I worked at Valkyrie, I had limited trading relative to compliance for compliance purposes. So keep that in mind. But you can kind of see, hopefully automatically, when and where I am accumulating or getting back into the market. Sold a bunch in 21, 20, 2020, right? I avoided all this nonsense. I can't remember exactly what I did in July, honestly, or August, whenever that was. But you can see for the most part, I'm buying strength here. If these are lump sum buys or if these are, paycheck waiting to get back in the market type stuff. This was the inverted head and shoulders. This was the falling wedge. This was the 28K breakout, right? And then this recent move is after I rotated out of Sol and Link and into BTC. But you can see I've had no sells this year, okay? No sells the past 2 years on this chart because I'm focused on fundamentals, long-term flows, right? All that ETF type stuff. Did I bottom tick the market? No. That's okay. So that's one example on one account where from the lump sum approach, the price is irrelevant for the most part. I just want, maybe on a micro basis, kind of a good level. You could have watched the 200-day moving average. You could have watched tons of other stuff. There was that Adam and Eve down here. There was inverted head and shoulders down here. Tons of stuff, right? But I think most people, if they're lump sum buying, it's kind of going to look like this. Probably once a quarter on average, they're going to make their trade into the market. So as an example, for the weekly cloud, right? One thing you could have done is said, okay, I know what usually happens for these setups. They're usually once every 2 years, every 4 years, maybe on a bull side, on a bullish reversal. That means these should be sized significantly, right? High confidence, extremely rare, but you have to get to the point where you understand that type of setup. So I'll post this thread in the description of the video, but again, this just illustrates like, look, I'm not worried about anything other than the stop loss because I think I know where this is going to go. In this case, your stop loss is the Kijun, which was at 25 or something like that. And I know a lot of people who caught this trade that was sized pretty significantly, hopefully for most of them. But this is one trade every 4 years that that you get a pretty decent shot at hitting your level. Doesn't always happen this fast, right? This is rare, but a great example of a time when you want to make sure you're sized appropriately and you understand what the upside potential is in your setup, in your trade. Now, if you're an investor, if you're long-term, you don't care, right? Just as kind of I don't really care in my long-term investor allocation partition. So there are lots of ways to skin this cat, depending on what you're trading and where you're trading it. Here's another example. We've been watching this ascending triangle mess, and I waited a long time to do anything here because this could have been a head and shoulders. This could have been just a breakdown. This was very, very ugly. Okay. So you're waiting, you're understanding chart patterns typically play out when the pattern itself is 3/4 complete, at least on triangles. Great. So you start sizing up accordingly when it looks close. I think waiting for the breakout is a little late in crypto for the most most times because it goes quick, right? So here your stop loss is any low or low. Again, it's boom, boom, boom. Don't even think about it, right? It's not like, oh, what's this wick at 38 or whatever. No, just like, what's the obvious level? Okay, it's 36.6. Great. I'm accumulating anything below 38 as often as I want, as confident as I want to be. Maybe that's a unit size consideration. Maybe that's the entirety of a sub account, right? Whatever. Something else to consider here is coin margined versus cash margined. And in bullish periods, you want to have a coin bias, specifically for BTC. In bearish periods, you probably prefer a USD bias towards the end of a run. Maybe that flips, right? Maybe as we're getting closer to a potential inevitable local top here, maybe instead of focusing on taking profits into coin, you want to take profits into cash. Maybe your positions want to be cash, right? Just another variable to think about. They're always trying to maximize your P&L. So great, we get this ascending triangle, bullish bias. We get the breakout, we will move up the stop loss. We have a target in mind automatically. Again, this is just measured fibs based on the depth of the pattern. That's all we're ever doing. We're just looking at the depth of the chart pattern, measuring it forward. That gives us a range. And we just wait. We just let it happen. There's nothing to do, right, at this point. Now, you could argue that there's plenty of evidence to continue entering these trades on a lower time frame, because when you get these mini consolidation periods, you tend to print these Williams fractals, these resistance fractals, and when you break above those in that system, that is a sign to continue to add to the position. The trailing stop loss would be the support fractal, the green fractal here. These are just called Williams fractals on TradingView. So before the pattern breaks out, there's not really a fractal to watch. You're just watching a specific horizontal level in this case. After the breakout, then you can start applying the fractal stuff a little bit more seriously. So again, when you're thinking about unit sizes, and maybe you said to yourself, as I should have said to myself, hey, I need to size this up more after the breakout. What do I do, right? I think at the time I said if we get back to 38, I'll add to that. But what the fractals are telling you is, okay, great, you have the breakout, correct. To add to that would be anytime you're exceeding that fractal. In this case, it worked out perfectly. It's not going to work out every time, but 38.7 looks to be about that fractal break. So you'd add to the long, right? If that's some sort of unit size or whatever you want to, however you want to handle that. The next breakup was around 39.7. So you'd add again, right? All this whole time, your stop loss is still at 37.6. And then as we're entering this take profit zone, you have the optionality of saying, look, I can, and maybe should most of the time, take partial profits here. Some profits. Now I knew 42 was that weekly level, right? So everybody, including myself, was kind of focused on that 42 level. So I said, you know what, just let's let this whole thing run potentially to 42, because it looks like it wanted it. And that's where the intuition comes in. Sometimes it's going to bite you. Sometimes it's going to go in your favor. But as this is playing out, I can see a lot of people potentially getting nervous that this is going to pull back in an overnight candle. This is going to go against me. This is a car payment, rent payment, house payment, whatever, right? The numbers get big and you'll get more comfortable with that over time, but you just have to get comfortable being in profit. A lot of people are super comfortable holding negative positions and being in losses, but they are very uncomfortable holding profits. They're very uncomfortable adding to positions, okay? So again, you had two great re-entries on here. Even if you miss the breakout, the fractals are great for entries. Anyway, kind of an unusual setup, but this pattern so far has worked out beautifully. Stop losses have moved up successfully. This is even on the 2 hour. I think it was last night when we overshot. We're pretty wicky on low time frames. It was like, okay, I'll take off 25%. I guess this was 2 days ago now. Last night, another 10% I took off. Today, I took off another 10% when we hit additional targets. So this gets very personal very quickly when you try to understand, do I want to just go all in at 38, all out at 42? Do I want to massage this a little bit? Do I want to sell half on a double? There's always that where you're just letting it ride. Are you concerned with funding? Are you concerned with open interest? I mean, there's a ton of variables here that I think most people inherently pay attention to. This, by the way, also gave you another entry at like 42.1, which I think is insane. But if I would have listened thus far, I think we're at what, 43.6. Excellent profit still. So definitely an unusual time, but a great example of making sure you're sized appropriately, when to add, when to subtract, and how to let the runners run, setting yourself up for an opportunity of success. Okay, that's the most important thing. One last thing I'll mention, this is 2015, 2016, 2017. As an example, what we may see is very similar to this chart in a lot of ways. So we're coming off of a bear market period in a pre-halving year. We are past the 50% retracement of the previous bear market at this point and approaching the 61.8 fib, which is around 47, 48K. So there's two things to watch on the weekly into halving. The first being the 20-week moving average, which historically, this white line has been excellent at letting you know we are still in a bull trend this whole time, right? Sometimes it doesn't always look this pretty. On the way down, it certainly didn't look turbo bearish the entire time, right? We peaked above the 20-week here. So again, unusual, but textbook. This is what you want to see. Above the 20-week the entire time. That tells us we're looking for longs. We're looking to add to our longs. We're looking to find potential upside targets continuously. And we will have some sort of news event. We will have some sort of catalyst, as we inevitably always do, where we see absolutely vicious and brutal drawdowns within the cycle. Retracements, retrenchment, whatever you want to think about that as. 30%, 40%, whatever. So when we're talking about taking profits over here on leverage, where do we get back in on spot, or where do we feel comfortable putting bids? The 20-week is a great spot for that. Fractals on the weekly are great. Super slow, okay? Absolutely turtle slow pace, which is excellent because it keeps you in. It keeps you in the trend when a lot of people just can't handle it. They just can't handle it, okay? They're just not used to being in profit, or being in profit for an extended period of time, or being in profit for some amount of dollar value, right? And again, the Williams fractals, we may see something like this, right? We may see buy the rumor, sell the news on ETF day in January. Then you have like tax selling. Then you have, oh, GBTC is unlocking 300,000 BTC selling, or some other thing, right? We still have GOX coins. It doesn't matter what it is. It's, at the end of the day, all kind of silly. It doesn't really matter. But that'll be enough for people to say, all right, we're up 150% from the bottom, or whatever it is, and it's time to sell off now. So I would look to the 20-week moving average, and then within the cycle, I would look for being sized appropriately based on fractals. This is just an easy way to automatically, again, not really think about it, and to continuously buy strength, which is, I think, why I like something like this. If you're holding a long bias, you've got a reason to stay in the trade. If you're short, again, you're holding a short bias, reason to stay in the trade. Anyway, so I hope this was helpful, but you have to do a lot of like internal personal work to understand, how am I quantifying my edge? Where the heck do I want to trade? What instruments do I want to trade? So none of this was financial advice. This is just examples, investment examples, not advice. Like, dislike, comment, share, subscribe, and happy trading.